Welcome to JM Financial Mutual Fund's Equity Outlook. In this short video, we would take a look at how different economic and market factors behaved in the recent past. We would also look at our view on the Indian equity markets, which may in turn impact the positioning of our schemes. The Nifty index declined by 2.5% for the month ended August 2023. The Nifty Mid-Cap 150 index and Nifty Small-Cap 250 index outperformed the large cap index and were up 3.9% and 5.1% respectively. This trend has continued for the past few months. Sector-wise, media, IT and pharma were the top gainers, whereas energy, financial services and banks were the laggards. FII flows continued to remain positive in August. Domestic inflows remained strong into mid-caps and small caps, while large caps witnessed some redemptions. Market valuations have been in line with recent past for large caps, but mid-caps have nudged up. Global indices also declined in the month of August 2023. Dow Jones and Nasdaq were down by 2.4% and 2.2% respectively, and the FTSE 100 was down by 3.4%. The India VIX, or the volatility index, saw an increase in August. It was at 12.06 compared to 10.41 in the previous month, higher by 15.8%. The Chicago Board Options Exchange, or CBOE VIX, was almost flat as compared to the previous month. Post the US Federal Reserve action to raise rates to 5.25 to 5.50% band in July, GSEC rates have hardened in the US and India. The US corporate bond spread over GSEC is revealing a distinct risk aversion. The corporate AAA spread is a mere 77 basis points in line with historic lows, while the corporate BBB spread at 170 basis points is on an upwards trend. Higher interest rates in the system is also shifting money away from equities and deferring expenses. Delinquency rates are increasing in the US among consumers. This implies that consumer momentum or consumption momentum in the US is likely to decrease. The key risk, however, emerging in the US economy could potentially be smaller banks facing a liquidity and cost of capital issue simultaneously and asset quality challenges on the other hand. Further, the commercial real estate sector is going through challenges which could potentially spin into a crisis. On the home front, India's inflation has been led by a sharp increase in food prices, and CPI for July increased to 7.44% due to a sharp increase in vegetable prices. The government has tried to curb shortages and food price increases by imposing restrictions on exports, but its efficacy is yet to be seen. WPI has been negative for the second consecutive month, indicating that global commodity prices are cooling off. This trend can help reduce the end consumer price as well. Corporate performance seemed good in Q1 FY24 for overall profits growing by 33% YOY and 8% sequentially on the back of improved performance of OMCs and financials. There has been a sharp decline in profits in chemicals on the back of inventory drawdown and heightened competition from China. There has been an improvement in profits of FMCG and healthcare companies. High interest rates, a brewing banking crisis, with many of the smaller banks fighting for survival as they face twin pressures of liability costs increasing and asset quality deterioration, and low tenancy in the commercial real estate sector have made things quite uncertain in the US. We are witnessing the volatility index increasing slowly as nervousness in markets increase. The Chinese economy is witnessing a slowdown as its manufacturing and capital expenditure is curtailed by high debt levels. India continues to perform well across parameters. An upswing in corporate profits, high government capital expenditure, and capacity additions in the private sector could help increase the momentum. The key challenge for the Indian economy continues to be inflation, both domestic and imported. Ahead of elections next year, the risk of populist measures increases, which could threaten fiscal discipline and raise rates. We remain cognizant of these risks. Market valuations have limited upside, and hence most of the capital appreciation will have to come due to earnings growth. India's global exposure has been steadily increasing, now close to 50%, as measured by imports plus exports by GDP. This implies that global volatility in sectors such as IT and other export-oriented sectors may affect growth prospects of Indian companies. Our portfolio strategy has been to increase defensives in sectors such as consumer and some pharma stocks as well. We have reduced our exposure to commodities as we believe that their cash flows may be impacted due to weakness in demand. We have increased exposure to domestic infrastructure beneficiaries beneficiaries, such as financial companies involved in project financing and construction companies as well. The domestic economy might continue to be resilient, though a slowdown cannot be ruled out. We advise investors to maintain higher levels of liquidity than before to buffer themselves against increased volatility. In the past, we have witnessed sharp drawdowns when the euphoria in market declines, and having liquidity could help investors to take advantage of such market movements.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.